why does that happen? Well, simply, if the economy's booming, people have more money to spend, and it tends to be positive for assets. And if the economy is slowing down or negative, then you tend to find that asset prices don't do as well. Kind of makes sense. Some assets work the opposite way around generally. So usually when things are slow, bonds do very well, but equities do badly, for example. And the easy way to see this, well, it's not so easy because you can't do it without putting it in a spreadsheet. It's actually the year-on-year rate of change of almost every asset, whether it's copper, oil, the S&P 500, bonds, yields, anything. They're basically related to I use the Institute of Supply Managers survey, the ISM survey, which is a monthly survey that basically tracks GDP, so economic growth. And it shows you that as soon as you make these things year on year, they look identical to the economic cycle. And that's the kind of big unlock, is realizing the economic cycle drives all asset prices. If you know where that's going, you can kind of make forecasts about asset prices. The rise in interest rates, the rise in commodities, and the rise in the dollar, and it's like financial conditions. And that's suggesting that the economic cycle goes almost immediately to recession, and pretty sharp. And I think a lot of people are sensing that is happening. You're hearing it from companies, you're hearing it from a lot of people to say, yeah, looks like we're going to recession. So the forward-looking stuff suggests we're about to go into a severe recession. So now you need to figure out, well, what are asset prices pricing in already? Because you can't trade on today's news. You need to trade on tomorrow's news. And really speaking, you need to trade 6 months out news. And so where are we? So if I look at the year-on-year rate of change that I talked about, if I look at the S&P 500, it's already pricing in about 42 in the ISM, so a full recession below that 47 level. Could it go a bit further lower? Yes, because my forward-looking indicators suggest the ISM could get down to 40 or so, maybe a bit lower. But we're kind of in the right zone to say, actually, a lot's been priced in. Could there be one leg lower? Maybe. But that means that as an investor, your spidey sense should be up saying, hey, is the opportunity coming here to buy when everybody else is fearful? So again, my forward-looking indicators suggest that the economy picks up maybe in the first quarter of next year. So in which case the markets will start to forward look some of this. So it's actually a little bit of a tricky point in time today, but we're getting very close to the time where the markets will start saying, okay, I can see what's going to happen here. The economy is going to go into recession. The Federal Reserve will stop raising interest rates, as will the other central banks. And chances are things start reversing again.
And I think retail investors' consensus as well, one of the most searched terms on Google this month when it comes to macroeconomics was, will the markets crash in 2022? So I think people feel that something is potentially looming. And if we look at potential survival kits for recessions, how my grandparents might treat this is very different to how I would treat this. They would stuff cash under the mattress, whereas the younger generations might try and be a little bit more agile. It is still quite difficult to work out how to navigate this perfect storm. If you play it well, it could be very profitable for you as an investor, but also there's a lot of room for risk and error as well. So how would you say to navigate if we do hit that 47, as you mentioned on the ISM, if we do start to see indicators of a recession, how would you move from here?
So generally, he who has cash in a recession is king, because you want to be ready when nobody else is, when everybody's being forced to throw all their trades out and stop themselves out from losing money. You want to be able to buy. So you kind of want to have cash ready, and then you want to see what the economy does, and then start to see, hey, are bond yields coming down? Are the Federal Reserve going to stop raising rates? Those are kind of signals that the future economy in a year's time is not likely to be as bad as what we're seeing coming in the next 3 to 6 months. And it's that transition that becomes very interesting for investors. So, basically, if you're young, you should be risk seeking. If you're old, you should be risk avoiding. It's as simple as that. So if you are young, you should be looking at, okay, how do I take advantage of the sell-off in crypto and the sell-off in in stock markets and technology stocks, because those are the things that will drive returns over the next 10 or 20 years. But if you're older and you're retiring, you want to stay in cash for longer. You don't want to take as much risk because you don't have an income. It's different, but it's always similar. So the question about 2008 was different. 2008, we had a financial crisis. So we had another thing. It wasn't just the economy slowing down, but we had something much worse. And 2001 was much worse. We had the biggest stock market bubble in history that unwound. This time around, I'm struggling to see what that big thing is. Yes, we've had inflation, which is different to the prior cycles, but inflation is also driven by the business cycle, and it should come down over time. So I don't see the really terrifying outcome. Of course, some companies might go bust. People will lose their jobs. Maybe some weaker economies will suffer badly. But generally speaking, I'm not picking up, oh my God, we've got a debt crisis coming or something really bad. So I think it is different. And so a lot of people are expecting the next leg down. Is this going to cause the crash? I mean, the markets are already down. I mean, the Nasdaq's down 27%. It was down 35% or so. It's pretty much crashed once already, but people are like, can it go down 50%? Because they look back at 2008 and 2001 and said, see, it can do that. When you go back to other recessions like 1990, it was a 20% correction. In fact, even when the Volcker years, the famous time when Paul Volcker was raising interest rates and slaying inflation, the market fell 27%. So it wasn't the big one. But 1974, it fell 50%. So we don't know whether it's a 50% sell-off, which is usually driven by something much worse, or something around 30%, which is roughly what's priced in right now. I'm erring to the 30%, so i.e. the risk reward is looking more attractive. Single best risk reward is crypto, because it's the only market that goes up 10, 20, 50x, while the stock market may double, may go up 200% over the next 5 years, but crypto market does a lot more. So if your aim is to take risks to accumulate wealth, then crypto. I prefer crypto as a bet because I think it has a better risk reward than other markets. But you have to suffer these drawdowns, and a lot of crypto is down 60, 65%. But if you're less risk seeking, you might just want to buy equities. If you're slightly more risk seeking in equities, you might want to buy technology stocks, because technology is not going away. I mean, the rise of everything from AI to robotics to EV to space travel to everything is all happening at the same time. We've got this huge inflection point. So clearly that's going to be something that's probably going to generate a lot of profits over time. So I think it depends where you want to be on the risk curve. Some people like physical things, so they like to own stuff like oil companies, because there's not enough oil being produced currently for world demand. So maybe over the next 2 or 3 years that does well, but those stocks tend to be mean reverting, i.e. they kind of just go in cycles. They're not the buy and hold that technology can be or crypto can be. So I prefer technology and crypto overall. It's still today, 100% of my liquid net worth. So all of my savings that I don't need to cover my bills is in crypto. And I've been adding because we're at that point where the economic inflection point is going to change, and that tends to be quite good for crypto. So I don't expect everybody to do that, because liquid net worth is different to entire net worth. I've got houses that I don't have mortgages on. I have an income. So the amount of risk I'm taking is actually not as big as it sounds. And first time around 2013, it was significantly less because it was riskier. We didn't know, was this technology going to survive? Was it going to be banned? All of the questions that have now mainly been resolved. We didn't know that back then. It's like, here's a bet. I think I wrote the first ever macro strategy piece on Bitcoin in 2013. And I said, it was $200 at the time. I said, listen, if we value it like gold, it could be worth $1 million. So let's assume I'm an idiot and discount myself by 90%, still worth 100 grand. And therefore at $200 with the upside, you could lose all your money, but the upside was 100,000. I'm like, this is the best risk reward I've ever seen in my entire life, and the best one any of us will ever be given. And that actually proved out to be the case. Or thought, this is interesting, and people got involved. Because, our job is to look for really interesting opportunities that other people haven't seen. So a lot of people weren't so skeptical. The skepticism came later in about 2017 when retail investors got involved. And then a lot of people didn't like it because the returns had been so big. They're like, at all times, it's a bubble, because they didn't understand how this kind of very powerful technology worked. So those voices of dissent were much bigger in 2017 all the way through to today, because it's questioning people's very system of understanding of financial markets and what is technology and how do they work. They kind of think it's crazy that a bunch of us are happy to see the market go down 70% and think that's normal, and then go up 20x. They don't see those kind of things, so they don't understand it, so they're kind of fearful of it. But in the early days, people were much more like, this is interesting. Much like we're observing the rise of AI or what Elon Musk is doing in space. They're like, it's interesting. But when it becomes a big thing, they all go, no, this is crazy. The crypto ecosystem is there is so much happening all at the same time. I mean, they've just raised $60 billion in venture capital, and everybody's building out projects, whether it's lending markets, financial markets on DeFi, whether it's putting traditional financial markets onto blockchain rails, whether it's putting real estate onto blockchain, whether it's building, doing really interesting things with NFTs, such as ticketing. So we're seeing Ticketmaster has issued 10 million NFTs, the largest NFT issuer in the world. That's going on. We've seen Solana building a phone which integrates all Web3 in your wallets. You've seen, I mean, there's literally almost too much to keep on top of. So, how do you pass through all of that excess of information? You start looking, okay, what are the main chains that the activity takes place on? And the main place is Ethereum, and then places like Solana, Avalanche, Polkadot, and a few others. So that's how you kind of filter down. You see all of this stuff going on. You're like, oh, this is overwhelming. But then the great thing is what platforms they're being built on, and then we can invest in the underlying platforms and protocols. We've always been very Web3 forward. We've got an NFT community, and we're building out a whole bunch of Web3 things. Stuff like crowdsourced tokenized trading, where the crowd chooses the portfolio allocation, and you can invest along with all the Real Vision members. But we also realized maybe 2 years ago that the metaverse was the future of all websites and experiences. So I kind of went on the side with Damien and built out a metaverse headquarters for Real Vision in crypto voxels. And that was just the first test. We weren't really going to use it for a lot. We just wanted to get our feet under the table, establish what it could be for us. Now we're building some more experiences, and we'll build out a full experience, because, if you think about people in the Real Vision community, they are like-minded. They're investors, whether it's in crypto, traditional markets, or both. They like to talk to each other. So why would you not create a trading room where I could sit next to you and I can kind of look over your shoulder? What are you looking at today? That kind of experience, because we're in this digital world now, and physical proximity doesn't matter. Like, I'm in the Cayman Islands today and you're in Dubai, yet this technology allows us to chat as if we're in the same room together. So the metaverse is going to create these experiences that bring people together. And also, I think will rechange entirely what we think of websites and platforms. I think Mark Zuckerberg understood this, that the Facebook feed is out of date for where the world is going, that the world will be, because what are you doing on Facebook or Instagram or any of these things? You are basically communicating with friends and others around you and kind of dropping into their lives and all of this stuff. So why should that be in a 2D feed of stuff? Why should it not be in something more immersive where we could hang out together and do this interview in feeling like you're in a room together? And that's where we're going. It's just a matter of time, and everybody's building out for that vision. It's the same for the person in Dubai as it is for India, as it is for Kiribati, as it is for New York City. It's the same thing, right? We've never had that before. And the access to it, yes, you could trade foreign exchange, which is a globalized asset, but it's actually not that easy for people to do. But this is super easy. So we've never had this before. So I think you're right. I mean, it's really interesting. The most powerful thing that I ever created was a network. And I didn't really realize that. And my network started at Goldman Sachs and maybe before that. And then the people that came into my network along the way, if you give them good karma, you're good to people, you help people, what happens is it builds, like in crypto, this network that has value to you as a person and also to the other people. And so even in this digital world, having a network of people around you, don't have to be physical, that you help out and they help out you, you don't realize the opportunities that's going to bring. And you measure yourself by the quality of that network too. Sure, we've all got a bunch of friends we grew up with that we're just kind of stuck with because we grew up together. That's okay, but you need to be actually careful about who you want in your network. And it is immensely powerful. It doesn't mean it pays off today, doesn't mean it pays off tomorrow, but it pays off in the end because you'll be smarter, you'll see more opportunities, and you'll have more opportunities. And that is a really powerful thing. Bad in this, because it's pretty straightforward. It's the same trade. When I bought Bitcoin in 2013, I was super early. And I had a long-term thesis, and I knew it was going to be volatile and it could go to zero. So the idea was, I bought it. It went up from 200 to 1,000 in 6 weeks. I'm like, oh my God, I've never had something do this before. Then it fell 87%. And I kind of like, fine, you know, I knew it could go to zero, but I think it's got a much bigger upside. And my thesis was 100,000 up to 1 million. And then it kind of did nothing for a while and then took off. And there were the forking wars happened in Bitcoin back in 2017. And I got confused and worried that, okay, I don't know what this is going to mean. Is this all going to fall apart? And I was now up 10 times my money. So I took profits and I felt like a god. And then it went up another 10 times. And I was like, that's okay. I've made 10 times my money. I can't argue. Then it crashed again. And I eventually knew that crypto, and particularly Bitcoin at the time, and macro would merge in the next recession. And that I really wanted to own it when it got sold off in a recession. 2020 comes along and I really piled in with as much money as I could possibly scrape together. And it turned out to be a phenomenal bet. Okay, so that sounds amazing. I went back and re-looked at that whole series of trades that I did, which look on paper genius. I went back and realized if I'd have just kept my initial investment and not done anything else, I'd have made 5 times as much as I did by trading it. And then I worked out one more piece of magic, which was if I'd actually bought crypto every time it did these big sell-offs and just added to my position in the same size I had originally put on, I'd have made 25 times as much money. So here I thought I'd done it really well. But what I screwed up was time horizon, because I knew it was going to be a long-term time horizon. And I ended up trading shorter term. And on paper, it looked like I was a genius. But the reality was I was a fool.